I am Jordan Schwartz, the Executive Vice President of the Inter-American Development Bank, and it is an honor for me to moderate this conversation with central bank presidents. We have not prepared. These are very prepared people. You know this, I think. These are a tremendous set of professionals, and I will introduce them in a moment. But we did not prepare all of our questions, so maybe we have a little bit of, every once in a while, a surprise from a central bank governor, and this might be the morning in which we achieve a little bit of spark. But let me first welcome our esteemed panelists, to thank them, to thank you for joining us today. We have Ms. Rosana Costa, the governor of the Central Bank of Chile. We have Mr. Leonardo Villar, the governor of the Central Bank of Colombia. Mr. Roger Madrigal, the governor of the Central Bank of Costa Rica. Mr. Richard Biles, the governor of the Central Bank of Jamaica. And Diego Labat, the governor of the Central Bank of Uruguay. It's an honor to have you at the IDB to discuss with you the most pressing challenges of monetary policy that our region is facing. To frame the discussion briefly, as highlighted in the recently launched Latin American Caribbean macroeconomic report of the IDB that we've been discussing for the last couple of days, the central banks in the region, across the region, in large, responded promptly to the global inflation challenges posed by the post-COVID world, while keeping medium-term inflation expectations stable. So that's kind of the foundation understanding that we bring into this morning's discussion, that we've done much right over the last couple of years. At the IDB, we have seen how central banks in the region implemented decisive but varied approaches to monetary policies in response to global inflationary pressures. These actions included substantial interest rate increases to curb inflation, stabilize economic conditions, even before the United States Federal Reserve decided to raise rates. Central banks in the region were particularly concerned about the possibility of inflation expectations becoming unanchored and the recurrence of past crises. Tightening of monetary policies helped to curb inflation rates and prevent future economic instability. The IDB has also highlighted the role of central banks' independence, another break from the not-so-distant past, in effectively addressing these challenges. Eric and I were just discussing what has changed over the course of the 30 years that we've been holding these meetings, and probably the independence of the central banks and the capacity to make quick, rapid, and decisive decisions on rates in the face of crises, in the face of supply chain disruptions, in the face of exogenous factors that are inflationary, is one of the great advances since Professor Hausman started this network 30 years ago. Independence is integral to making markets confident and ensuring that monetary policy decisions are based on economic indicators and professional judgment rather than political considerations. Inflation targets in the region, including all the countries represented on this panel, benefited from the appreciation of their currencies subsequent to their interest rate hikes. This currency strength not only supported their ability to combat inflation at that moment, but later gave them headroom to reduce rates in favor of growth. The market's trust in these central banks' policies facilitated a smoother transition to lower rates as inflationary threats subsided. These strategies underscore a broader lesson on the necessity of robust monetary frameworks and the need for central banks to act decisively and preemptively. To continue with the discussion of these topics, we'll begin today's agenda with the presentation from our panelists. So you will each have 10 minutes to update us on your country's monetary policies, recent developments. This sequence will not only broaden our understanding of individual country policies, but also allow us to piece together a regional picture of how monetary policy is being leveraged for economic stability and growth. If you look among yourselves, you'll see representatives from every sub-region of the continent, from large economies and smaller economies, and from those subjected to different types of exogenous factors and stress. After these interventions, we will open a conversation to delve deeper into the discussion on the opportunities and challenges of inflation, monetary policy tools, and the road ahead in Latin America and the Caribbean. We aim to cover some of the most important issues and concerns for our region. I will just mention also to the panelists, mind you can speak in English, speak in Spanish, you can speak in Spanglish, like much of the work at the IDB. We have simultaneous translation, I believe. Is that right? And I will come and join you. Well, first I'll ask Governor Rosana Costa give us her remarks on the monetary updates in Chile, and I'm going to kind of walk in front of you, which is un poco mal educado. I'm sorry. But I will turn the microphone over to you, Governor.
Now, good morning, all of you who is in person and the one who is by telematic way. Macroeconomic in my country. The Chilean economy has progressed in resolving the significant macroeconomic imbalances of previous years, and inflation has declined, reaching 3.2% in March. This scenario is clearly different from the double-digit figures we saw a year ago, and is already much closer to the 3% target we have in my country. Also, core CPI inflation has fallen, reaching to 3.7% in March. Additionally, the two-year inflation expectation have remained at 3% for several quarters now. The process of inflation decline has been heterogeneous across its components, with a faster decrease in goods than in services. This is consistent with a moderate pass-through of the exchange rate depreciation and the significant relief of global cost factors in previous years. For its part, the relevance of indexation processes is the inertia of services inflation stands out. At the turn of 2024, both January and February had variation above expectation. In January, this was focused on increased prices of foodstuffs and goods, some of them responding to the currency depreciation. In February, it was explained by the rise in the prices of some services. However, March was somewhat below expectation, supporting some caution in projecting inflationary trends in one direction or the other, given the high monthly volatility we have seen. Regarding activity, after contracting at the end of 2022 and early 2023, Chile's economy resumed positive quarterly growth rates in the second half of 2023, resulting in a growth rate of 0.2% of GDP for the year. During January and February, monthly activity has also better than expected. However, a relevant share of the upward surprise was due to transitory factors such as power generation and mining. Although this dynamic will raise the first quarter GDP, the transitory nature of some factors point to a slowdown in activity in the short term, in line with our previous projections. Demand has been somewhat weaker than projected, particularly in its tradable components. Private consumption had a slow recovery after a prolonged adjustment. Investment in 2023 had a better start of the year, but dropped significantly in the second half, mostly driven by the more volatile machinery and equipment component. Labor market has tracked the business cycle. Employment has gradually recovered in its pre-pandemic trends, but employment remained above its long-term average. Real wages continue to increase, although they remain below the pre-pandemic trend. In this context, the board of the central bank has lowered the monetary policy rate by 475 basis points from mid-2023 to 6.5 at the beginning of April. This reduction has passed on to the cost of local financing in line with the normal transmission of monetary policy. The mismatch between Chile's economy cycle and that of other economies has affected the country's interest rate differential, particularly with respect to the Fed and other Latin American countries. These divergences have been adding greater than expected pressure on the peso's performance and volatility, along with the movement of its other fundamentals. Our currency had depreciated significantly both against the dollar and in multilateral terms since the start of the year. Our latest projection of GDP growth stands between 2 and 3% for this year, converging to potential growth after that. Recent data suggests that the output gap will be slightly positive in the short term, mostly due to the previously mentioned transitory factor converging to zero over the forecast horizon. Private consumption is projected to continue its moderate expansion in line with the recovery of the labor market and more favorable financial conditions. Investment is projected to contract still further during the first half of the year, but to increase after that, in line with lower interest rate and the projected appreciation of the Chilean peso. Current account deficit, after reaching 3.6% of GDP in 2023, will be at 3.4% during 2024-2026 period. Headline and core inflation will rise to 3.8% in December 2024. The figures we had on the past report was 2.9% and 3.2%. This correction is influenced by the recent depreciation of the peso, the deterioration of global cost factors, including price of oil, and higher inflation early in the year. In the medium term, among other factors, the convergence of inflation to the target will be driven by an economy that expands close to potential growth and a real exchange rate which is projected to appreciate as other countries catch up in their monetary policy normalization. So, regarding monetary policy, the board expects further rate cuts in the central scenario of the last monetary policy report. The magnitude and timing of the monetary policy rate reduction will take into account the evolution of the macroeconomic scenario and its implication for the trajectory of inflation. The sensitivity scenarios will define the borders of our corridor, consider situations where the evolution of domestic demand diverges from projections in the central scenario. The main risk scenarios go beyond the limits of the monetary policy corridor and are still mainly linked to external conditions. Wrap up. The Chilean economy has closed its significant macroeconomic imbalances of previous years. Inflation is close to the target, with inflation expectation well anchored. In this context, monetary policy is expected to further decline throughout the year. It is important to know that the central bank has greater flexibility to accommodate shocks that can increase inflation as long as they are judged as transitory. That said, geopolitical tensions and recent activity data underscore the high sensitivity of financial conditions to news, in particular regarding the persistence of inflation in the US. In this context, we must be cautious when evaluating the macroeconomic scenario and the appropriate speed of monetary policy normalization in our economy. Thank you.
Thank you so much. I was just taking notes and missed the quick ending to your presentation, but we will save those 3 minutes for questions
I
later.
surprised you.
You did surprise me. That was the first surprise of the morning. Exactly. And maybe we will ask Governor Villar if we'll just transition. We'll work our way through these. We'll all keep our mental notes together, and we'll come back and maybe make a couple of summary observations. But please, if you would be so kind.
Okay, first of all, thank you very much to IDB for this invitation. It's a pleasure to be here. In the case of Colombia, as in most countries of the region, monetary policy has gone through very stormy times during the last 2.5 years, or perhaps 5 years. The Colombian Central Bank increased its monetary policy interest rate by 11.5 percentage points between September 2021 and April 2023, when it reached 13.25%. At that time, inflation had reached its maximum level, close to 13.3%. Since then, headline inflation has gone down by 6 percentage points to 7.4% in March 2024, but the policy interest rate was kept stable until December, when we started a very cautious reduction process of to the current level of 12.25%, only 1 percentage point below its peak. I'm sorry. This implies that we keep a very high real interest rate and a strong contractionary monetary policy. Inflation has been more persistent in Colombia than in other countries in the region. The effects of a very contractionary monetary policy are materializing, and the reduction in inflation is expected to continue, but market expectations and our staff coincide in forecasting inflation around 5.4% at the end of this year, which is well above our 3% target. That's a huge difference with Chile. This implies that 2024 will be the 4th year in a row in which we do not comply with our target. In this context, it is particularly important for Banco de la República to guarantee that inflation converges towards the target by mid-2025, as we publicly announced in November last year. There are several reasons to explain the stronger persistence of inflation in Colombia than in other countries in the region. First, the initial demand shock in 2021 and 2022 was stronger than in other countries, as reflected in unprecedented GDP growth figures of 10.8% and 7.3% in those years, respectively. In 2022, demand was growing above 10% in real terms. Second, we experienced a very large currency depreciation in those 2 years, in which Colombian public bonds lost the investment grade due to large fiscal deficits. Such depreciation probably explains additional inflationary pressures that acted with a lag until mid-2023. Third, during 2021 and 2022, we experienced a very large increase in relative food prices that only started to revert in the second half of 2023. Fourth, the Colombian government froze domestic fuel prices in 2021 and 2022, which required the current government to adjust them very strongly, starting in the last quarter of 2022. This implied an increase of more than 50%, 50% in the gasoline prices during 2023. Fifth, both the previous and the current government have decreed very high increases in the minimum wage during the last 3 years, well above the observed inflation, thus creating additional inflationary pressures in the labor market. These decisions made it more difficult to break down the very strong indexation processes that are so common in Colombia. Fortunately, all these reasons in favor of inflation persistence. Despite all these reasons, several factors are now working towards a reduction in inflation. Relative food prices are going down. A strong currency appreciation is taking place since end 2022, partly as a result of international financial conditions, but also of an improvement in country risk perception as measured by risk spreads. Some improvement in the fiscal accounts, and last but not least, domestic contractionary monetary policy. As said before, headline inflation has gone down by 6 percentage points in the last 12 months, which is among the fastest reductions we have experienced in our own history. PPI inflation is negative, and core CPI inflation, which we define as inflation without food and regulated items, has gone down from 10.5% to 6.8% during the last 9 months. With regards to economic activity, the process of adjustment has been quite significant. In 2023, GDP experienced a stronger than expected slowdown. Annual growth reached 0.6% at the end of the year, less than the 1% projected by the central bank, and significantly lower than the estimates by almost all other analysts. The deceleration in economic activity was explained by a drop in domestic demand of 3.8%. This helped to reduce inflationary pressures and to adjust a very large deficit in the current account of the balance of payments that we had in 2022 of 6.2% of GDP. At some point, it was higher than 7%, in a quarter above 7% of GDP, to 2.7% of GDP in 2023. To a large extent, the adjustment in demand was led by household consumption, something we expected to happen. Despite such adjustment, household consumption is still above its pre-pandemic trend. The surprise was the huge decline in gross capital formation, which fell by almost 25% between 2022 and 2023, partly as a result of monetary policy contraction and a significant fiscal adjustment, but also very likely of policy uncertainty, which affected several sectors of the economy. In this context, the economy is expected to continue experiencing low growth rates this year, but with a positive trend and relatively good prospects for 2025. Central bank staff forecasts GDP growth to be 1.1% in 24 and 3.4% in 25, when we expect to reach a normalized monetary policy as inflation converges to target. Of course, downside risks in this front are large in a context of a strong political polarization, which increases uncertainty about economic policies in several important sectors of the economy. I stop here and open to questions and the discussion later.
Thank you very much, Governor. Excellent. Excellent. We're already starting to see contrasting lessons that are emerging, and I'm sure we'll come back around to that. We appreciate you ending with this point about sensitivity to external pressures, a point that Governor Costa also raised in Chile's context. May I turn to Roger Madrigal, Governor of the Central Bank of Costa Rica. Thank you.
Good morning, everybody. I just want to start saying thank you for this opportunity for the Central Bank of Costa Rica. For the benefit of the audience, I will switch to Spanish. So, bueno, tenemos la oportunidad de hablar de Costa Rica.
This is an opportunity for me to speak on behalf of Costa Rica, a small, open economy in Central America. At the beginning of our monetary policy story 3 years ago is quite similar, as we've heard. We're not at the end of that story yet. First, where do we come from? before the pandemic, we had a very expansive monetary policy with an interest rate of 0.75%. And before that, there was a monetary expansion due to encashments, which was equivalent to about $1.6 billion in monetary expansion. So when the shocks happened, we were in a very expansive monetary position, which means that the bank had a very short period of time, 10 months between December of 2021 to September of 2022, in order to go from 0.75 to 9% in terms of rates. As we heard from Colombia, we reached very high levels of inflation, perhaps the highest in 15, 20 years, 12.1%, perhaps the highest in 10, 12 years, not so much 15. But it was very high inflation that we had not witnessed in at least 10 years, 12.1%. The central bank, in an accelerated fashion over a relatively short period of time, as I was saying, between December 2021 to September 2022, interest rates were set at up to 9%. We import commodities as an economy, raw materials, petroleum. Therefore, the shocks has been in foods, for example. There were clear repercussions of that on the consumer price index. So little by little, the inflation began to drop. By June of 2023, May, June, inflation was very close to zero. And in the last 10 months, in interannual terms, inflation rate relatively year to year. In fact, March, our latest reading, the rate is at less than 1.2%. We have even experienced deflation in the last few months. In addition to that, a couple of other things have happened. One, there has been a significant reversal of the shocks, in some cases partially. Energy shocks, that's been reverted. The shocks resulting from shipping containers, maritime freight, that there's been a recovery there. That could happen, they could go back, that could become undone because of geopolitical shocks. But something that the central bank didn't try to do, but that just happened, was currency appreciation. The highest point was 700 colones per dollar. Now it's at about 500 per dollar. There was a reduction in the exchange rate of around 25%, between 20 and 25%. We have had some monetary responses as well as the real economy. The economy grew 5.1% in 2023. We're expecting growth of about 4%, 3.9% this year, and 4% in 2025. Which means that the central bank has a challenge now what to do with interest rates. Since March of last year, it was for 14 months, we've been in a cycle of reducing interest rates. And at this point, we have a rate that is below the US Federal Reserve rate. In terms of real factor performance, is a big discussion in Costa Rica. I mean, there's no proof of this, but some feel that it's not interest rate arbitrage what's happening in Costa Rica, rather that there's been a significant two-digit increase at about 7%. These are exports, 20% in free trade zones, that's agricultural goods, banana, pineapple, others. There were high rates last year, and the country was close to 9% of GDP, and now reserves are at 14% in nominal terms. Absolute nominal terms, central bank's reserves have practically doubled. We asked for a loan at some point in 2022, August. It was prepaid in March, between February and March. It's about $1 billion. So we have an economy with real growth at 4%, a significant drop in unemployment during the pandemic. It was at 24%. Right now, unemployment is at about 7.8%. We have international reserves that are not high by international standards, but they're high in terms of Costa Rican history. It's about 14% of GDP, with outlook for growth about 4% in the next 2 years, 4% in the next 2 years. And there's some challenges. Interest rates. This is not what the IMF said, or this is rather what the IMF said. We are the first country in the last 15 years with inflation, with flexible exchange rates, that has an interest rate that is below the U.S. Federal Reserve rate. We have not seen any capital flight, even though currency appreciation has continued. Its currency is now stable at about 502, 504 colon for a dollar. So the challenge now is, what do we do? Do we have space for additional interest rate changes? Something that the banks has been very clear about is that as interest rates drop, we need to be careful that we could be below the U.S. Federal Reserve rate, but we need to be very careful about that. That's something that Costa Rican analysts have not yet acknowledged, and that is that there is dollarization on both sides, both in terms of assets and liabilities for banks. If we would have capital flows, we would have not seen that. We're now seeing the opposite. There'll be some discussion on rates in Costa Rica next week. That's the situation. So an economy with deflation, high levels of reserves, unemployment dropping, the productivity gap is closing. There's some risk, obviously, and there's some concern on the asset and liability. I'll stop there if that's okay.
Muy bien interesante. Muchas gracias, gobernador.
Very good, very interesting. Thank you, Governor.
We have at target, above target. We have negative interest. We have negative inflation and interest rates below the Fed. And so this is maybe going to be a more interesting conversation than I had anticipated. And thank you so much. I think Governor Biles will turn to you. No, not at all. I have to turn on that microphone also.
Okay, thank you. Well, good morning, everyone. Thank you very much for inviting us to participate in this presentation. My brief remarks today will be focused on Jamaica's experience with a transmission mechanism during the tightening cycle following the inflation shock. In this regard, I'll be spending a moment discussing the challenges with the credit channel and the relative dominance of the exchange rate channel. This will provide insights into the bank's policy response, which continues to be geared at ensuring price and financial system stability. I'll close by highlighting the actions the bank is undertaking to improve the weak transmission system. To address rising inflation and heightened inflation expectations associated with the pandemic, Bank of Jamaica started tightening monetary policy in October of 2021, long before most advanced economies. The bank employed a three-pronged approach. Firstly, gradually increasing the policy interest rate by 650 basis points since October of 2021 from 0.5% to 7%. Secondly, deploying open market operations more aggressively to maintain tight Jamaica dollar liquidity conditions. This also involved increases in the domestic and the foreign currency cash reserve requirements that are applicable to the DTIs and a widening of the interest rate corridor between what they lend us or what we lend them. Thirdly, engendering greater stability in the foreign exchange market through foreign exchange interventions, both by buying as well as selling, and adjustments to the net open position limits of the DTIs. In Jamaica, we have found that the credit channel, which is the main channel targeted by the bank's monetary policy actions, has been quite weak. As such, we have observed that our policy actions geared at managing inflation expectations and the exchange rate channel have generally been more effective. As a small open economy that is dependent on imports, with approximately 50% of consumption being imported, one can understand the important inflation challenges faced by Jamaica in recent years, arising from the global macroeconomic environment. Since October of 2021, while maintaining a flexible exchange rate, the bank has therefore taken decisive actions in the foreign exchange market, primarily selling foreign exchange when necessary. Without these actions, imported inflation and hence the final prices faced by consumers would have been much higher. A major issue during the tightening cycle was a weakness in the monetary transmissions mechanism. Earlier in the cycle, the bank observed different degrees of pass-through of its policy actions to lending and deposit rates in DTIs and the non-banking sector, with the former instituting relatively small adjustments to deposits and lending rates. We expected deposit and lending rates to respond to the increase in the policy rate with a 1 to 3 month lag after the policy adjustments and a pass-through to range between 40% and 90% over the period. In contrast, deposit rates and lending rates have responded marginally to the bank's 650 basis point adjustment. At February 2024, weighted average deposit rates increased by only 145 basis points, while time deposits increased by 370 basis points. Weighted average private sector loans increased by just 40 basis points. Our research has shown the source of the weakness in the credit channel is primarily due to the concentrated nature of the banking system. This is evidenced by the dominance of two major network banks, which allows them to pay low deposit rates while maintaining their profit, even when subjected to monetary policy changes. In addition, given the time-consuming process of switching financial interests from one financial institution to another due to know your customer requirements, customers may be discouraged from changing institutions, even if they believe they are not receiving the best rates and/or services. This then constrains deposit portability. Notwithstanding the general weakness in the credit channel, we have observed a positive response of domestic inflation to the bank's tightening policy posture. Since its peak at April 2022 of 11.8%, annual point-to-point inflation has been on a general downward trend, moderating to 6.2% in February and 5.6% in March. This downward trend occurred in the context of lower imported prices, supported by a stable exchange rate and tight Jamaican dollar liquidity conditions. The policy rate has remained stable at 7% since November 2022, but the tight liquidity management has led to persistently high money market rates. The financial system, however, remains stable and able to withstand shocks. DTIs are well capitalized, asset quality relatively stable, and provisioning by the system is adequate. As I close, it is imperative that we improve the transmission system of the country. Jamaica has been exploring deposit portability and open banking as strategies aimed at improving competition and intermediation. BOJ has engaged with the World Bank for support, and we are in the process of developing a policy framework to promote and regulate an eKYC database for the sharing of customers' transactional and non-transactional data. The government of Jamaica is also in the process of developing a national identification system, which will provide a quicker method of identity assurance and verification, thus making it easier for banks to onboard customers. Thank you.
Thank you, Governor Biles. I think we'll turn to Uruguay, to Governor Labat. If you'd be so kind, you could stand, you can stay seated, however you're more comfortable.
Thank you, Jordan. Good morning for everyone. Thanks for the invitation. It's a pleasure for me to share this time with you, and I will use the license that Roger gave us, and I will switch to Spanish just to. I prefer. Just quiero empezar un poco poniendo.
I'd like to begin by providing a little context for those that don't know the situation in Uruguay. Very briefly, just to tell you that what these things that we're talking about, the phenomenon of inflation in Uruguay is not new, as it is for some countries. Uruguay, in the 20 years before the pandemic, had an average of 8% inflation. More or less endemic inflation, and before that, inflation was higher. And the diagnostic for that inflation was something that basically was a sentence for us, in that predetermined, in that we were condemned to that higher inflation because we were a dollarized economy and for other reasons. When we came in 2020 to the central bank with the new board, we had a hard, difficult task ahead of us, which is to try to change that. And we set out to build a robust inflation targeting regime to get Uruguay out of that trap. The idea was to empower monetary policy through a series of measures. And basically, that new policy, that new framework that we call Switch to Quality has 5 pillars. First, a very clear message to confirm our commitment to control inflation, to be very clear on our commitment toward inflation. And a clear signal was to reduce the range, which at that point was between 3.6 to 3.7, and it looked very difficult at the time because we were just going into the inflationary shock worldwide. We wanted to set a very clear signal of our commitment. The second pillar was to change the instrument. We started to manage interest rates, which was not done before. The third pillar was quite a sudden change in the bank's communications, trying to rejuvenate, if you put it that way, in inflation surveys, which were not very much used, trying to expand that survey, changing our communication with analysts, with other economic actors, with different audiences, changing the way we do our reports, improving our reports. So there was a lot of focus on changing communication. I was saying at the beginning, Uruguay is a highly dollarized economy. So the fourth pillar of the plan was to move toward de-dollarization. In order to take strong steps to de-dollarize an economy, you need low inflation rate for a long period of time. So we're still waiting to achieve that, but steps have been taken. There are measures, regulatory measures in place, some that the government has adopted, for example, for tax purposes that have helped that de-dollarization. So it's a long road ahead, but we believe that having a dollarized economy does not mean that Uruguay cannot have an inflationary target, but de-dollarization helps us. And then lastly, and this has been quite controversial in Uruguay, we've sent a signal that we're going to go to as free a floating rate as possible. In the first few months after the pandemic, we did intervene in exchange markets, but since August of 2021, there has been no central bank intervention. The message is clear: when there is market disruption, the bank could intervene, but clearly that's been our mandate. That's led to a lot of controversy, especially internally, and in fact, even with some institutions that have found it hard to understand the why of that. But Uruguay started this process because there was a huge deficit in our credibility, huge shortfall in credibility. Obviously, when you intervene in exchange markets, economic agents might read that as either market disruptions or the bank has a lot of targets and they're not so focused on inflation. Since we wanted to boost our credibility, that is why we have very much focused on a free-floating exchange rate. As several of my colleagues have mentioned, toward the end of 2021, the second half of 2021, at that point we understood that the situation was normalizing after the pandemic in terms of economic life. That began the cycle of contraction. It was 4.5. Our rate, we went up to 11.5. Based on that, we had good outcomes in inflation and expectations, which has made it possible for us to start dropping the rate starting in 2023. Today, interest rates are at 8.5. Our outcomes, I was saying inflation was an average of 8. Now it's at 3.8%. That's the lowest inflation rate since 2005. That's 3.5 less than what we had a year ago, 1% less than what we had at the end of 2023. So we're getting good inflation outcomes. We have been meeting targets for 10 months. In other words, inflation is in the target range. Our projections are that for 24 months out, it will continue to be in that range, which gives us peace of mind and has also had an effect on expectations, which is perhaps our Achilles heel. And this is what I would like to contribute to the panel here. We are where we planned to be 4 years ago. We have inflation where we wanted it. But in any case, there's been a change in expectations. It's been a good change. There's clearly on the downside. In other words, they believe in us, but we still have more to do. Obviously, when there's a huge shortfall in credibility, I'm fully aware that it's a long process and that it takes a while to get to convergence. But in any case, I think it's important to look at the trend, to look at where you're headed. And here I'll refer to what Roger was saying, because this is where we look at future challenges. Obviously, if you look at policy rules and other conditions, perhaps you might imagine that with an 8.5 rate, that's a relatively high rate, but if you have a significant shortfall in credibility, certainly Uruguay would have had to keep that rate at that level for longer than other colleagues that already had a consolidated regime with a different set of expectations around them. So today, we are at the ceiling of the range as far as expectations. We're certain that it's going to continue to drop, but that will certainly force us to keep the rates higher. What was a challenge for us? That means that when other countries begin to normalize, as Rosana was just saying, Chile has dropped their rate quite a bit. Other countries have moved more slowly, but they will begin to normalize. And that might put us in a somewhat uncomfortable situation, but we will certainly have to maintain the rate for a longer period of time. So that would be the main challenge, perhaps. But I think Uruguay's experience has shown that you can have constraints, but there are no countries that cannot set up an inflation objective, which was what was said about countries that are highly dollarized. And I think our experience shows that that's not necessarily the case. Thank you.
Cada vez más complejo, interesante. Muchas gracias.
Oh, it's becoming more and more complex and interesting. Obviously, there isn't a very simple way to exactly presume or fully understand what we've been hearing.
Baseline inflation, starting points, appreciation, massive appreciation of the currency, levels of dollarization, and very different fiscal experiences over these past years. So we'll ask questions that step back a little bit and give you each an opportunity to reflect a little bit more on the structure of your economy and the responses that you see, maybe to provide us with a little bit more insight on how are you looking into the near future, and what sorts of responses that you'll be that we might expect from that. I think would be interesting to talk a little bit about the financial sectors of your countries. Governor Biles stepped into this a little bit. The current condition of we saw credit shrink in 2023 in general in response to the increase in interest rates. Maybe this is not the case in Costa Rica, but certainly the case in much of the region. And I was wondering if you can maybe just give us a little bit of an overview of how you see the current condition of the financial sector in your country, and whether you believe the reduction in interest rates for those other countries here are enough to boost productive credit over this period of time. Maybe we'll go in order from here, if that's okay. Governor Villar, por favor.
Okay. Bueno, a pasarme a español.
Sí, ya no como quiera.
I'm going to switch to Spanish. I think there's a characteristic of this deceleration of the economy, maybe a semi-crisis. I don't think it's a crisis, but this adjustment, rather. And it's that it has occurred with a record measure in inflation, the most significant drop in inflation that we've had since the crisis in 1999, with an adjustment, a dramatic adjustment in every sense. And it's happened without having a problem in the financial sector. The financial sector, of course, there's been a reduction in profit, and the credit went from growing at a very rapid pace, which is one of the systems of this overheating of the economy. and which was one of the concerns that we had in mid 2022 with credit growth significantly above the revenues rate. But this has been done in a way that has not implied a deterioration in the financial sector, and many banks in Colombia are having losses. Why losses? Well, basically because there was a significant increase in the funding, and above all, there was an increase in past due portfolio. And that has taken them to have many provisions. But in spite of that, they maintain solvency levels significantly above what is required. And in that sense, the perspective to once again start this process is healthy, and it is seen with very good eyes. So I think that it is a very important moment. Very interesting.
Some liquidity pressure, but no insolvency. And the robustness of the financial sector able to withstand the pressures. I think, is this a similar storyline that we're seeing in Chile?
Similar story, in some way. Lo que estamos viendo en somos todos hispanoparlantes.
Well, we're all Spanish speakers, so I think that I could unleash my Hispanic part. Okay, so what is happening in financial terms, just to say, central bank has lowered interest rate by 475 base points, and therefore this is being transferred to the economy at the speed in which it is normally done in what corresponds to commercial consumption and credits, which have the longest time frames. The interest rates are following more closely the evolution of the long rates that we're seeing globally. So there we have an improvement in the financial conditions at a short term that are transmitted and transferred. This takes time, but this is done as would be expected. In parallel, we have a period of long, important economic stress and shocks, and the banks are very well supplied. They have relevant provisions, supplies. There is an expectation that there was the expectation that this cycle had to occur, and in parallel, we're implementing Basel III. Therefore, banks no more, they're strengthening their capitalization. So we're now in the development of the financial stability report. We see now what we have seen before. We see a solid banking situation. We don't see systemic risks, but we do have to acknowledge at the moment the level of accounts, unpaid accounts, and banks are preparing themselves for that. Now, what we're seeing at a level of the amount of credits, there is a precaution. The risk is present, and therefore there is a precautionary measure by banks. And when we have heterogeneous cycles, that is distributed differently among different sectors of the economy. There are sectors that perceive this with greater risk, and so there's more caution. There are also other sectors where the need for credit differs in regards to others. So on the side of the supply, there's a situation of caution, and then we also see a higher demand of credit, also reflecting this cycle that is changing its direction in the economy, but it does this with the graduality or the phase out that we saw at the beginning. And when we look at the opinion surveys, we see the same figure. There is a precaution that is increasing the demand for credits, and this credit demand or credit supply that looks at the situation with caution in general. There's a banking system that faces with this rate in the increase of these unpaid accounts and this transfer of the financial conditions from the monetary policy to the financial system.
Governor Madrigal, are we seeing the reverse in Costa Rica? Perhaps you can explain to us in terms of liquidity in the banking system as a result of the the exceptionally low interest rates compared to neighboring countries.
Bueno, hay varias cosas que destacar en el caso costarricense.
Well,
Uno es
there are several things to highlight in the case of Costa Rica. And with the different evaluations that have been carried out, we've seen that it's a financial system that is very well capitalized with a good liquidity level. And more recently, we've had this purchase of reserves, and every time the central bank buys a dollar, it gives domestic currency in exchange. So that has created an increase in liquidity that has led the bank and the money market towards this. So in general, the liquidity situation, I would say that it is between adequate and broad liquidity in the financial system. And in fact, we make an effort on a daily basis to sterilize the purchase of reserves. And there's been growth for several years at rates of around close to 7%. And there is a slight concern because it is growing. Credit in foreign currency is growing more. People that have income in local currency, they contract debt in foreign currency. So clearly there's an exchange rate risk there. And these risks by the debtor, if it becomes a massive thing, it becomes a risk in the balance sheet of the financial system. So that's what in general terms we see as to the pressure. When I heard President Biles to talk about this, the situation in Jamaica and the mechanism for passive and active rates, it sounded like he was talking about Costa Rica. It's the exact same thing. So this are very quickly transferred to liability rates. And so this is an indicator that maybe banks are having greater profit, which closely relates to yesterday's conference on the behavior of the financial system. So just to answer the question, we have no liquidity problems. On the contrary, we have an excess of liquidity that we have to manage. And through the different tests and with the different analysts and international organizations such as the IMF, the World Bank, when they've reviewed in the financial system recently, they've agreed on the same. Some say that we've capitalized with adequate liquidity. I'd say with broad or vast liquidity.
If we need it. Thank you, Governor Madrigal. Very interesting. And Governor Biles, you had started to touch on this question during your opening comments. Maybe you can go a little bit deeper and tell us a little bit about how the credit shrinking affected.
Thank you. So the credit crunch has had a different effect on the banks compared to the non-banks, because the banks have the cheap saving deposit base. They have not moved rates on their customers significantly. So they haven't given much, if any, increase on the savings rate, and they have pretty much held the lending rates to their best customers. At the margins, maybe with new loans, they have priced them a little bit more expensive. So that we have found that the growth of credit hasn't declined, and it's just been pretty stable. In the non-banking sector, which is where the money markets are managed, the impact has been dramatic. Rates have risen very significantly in synchronization with our policy rate. It's put a lot of pressure on the capital of the non-banks. Many of them have had to find capital to bolster their business fairly significantly, which is we consider good, and we see it as a signal of confidence in the Jamaican currency and in the management of the markets. We expect that credit will start to pick up once we bring rates down a notch, but we're going to be very cautious about bringing down rates. I believe somebody spoke about regulated price increases. we have had a couple of those, whether it's the tax-fair rate or the minimum wage rate. We've had quite a few of those regulated wage increases that have a profound effect on inflation, but which we have no control over. So we're going to be very cautious about how we bring rates down, even as we see it come within our corridor, which is 4 to 6%. I would say that for the next 6 months, we will be looking cautiously at the possibility of them notching down slowly.
Thank you very much. I was wondering about the logic of our seating, and now we have it. The de-dollarization corner is on the far side. Governor Labat, could you tell us a little bit about the financial sector's responses?
Sí, algún comentario ahí.
Yes, a comment there. Uruguay, as I said, has a dollarized economy and particularly a very dollarized banking system. 75% of the deposits are in dollars, 50% of the credit is in dollars. And we have a banking system with very high liquidity. So with that very high liquidity that also made that during the periods in which there was an increase in the rate, this was transferred more slowly to the credits, and it took several months to correct because of the excessive liquidity. And at the end, the rates were finally corrected, but it took time. I don't see that now when they start to decrease that will generate, well, it won't generate any inconvenience because somehow that is going to, well, the same thing that happened when it increased, when it decreases, there's going to even be more liquidity. So there should be no major issues. Now, in the banks, there was a reduction because if you think that a liquidity that is, depending on the bank, that is significantly above 40% of the overall asset, that made assets that were at zero rate for many years finally became profitable at the Federal Reserve rate, at least. And so the banks have improved during the past 2 years. And this is something that also gives us a certain level of guarantees. Now, if from this process, I do highlight, and it's something that we're seeking, as the rate of the domestic or of the national currency, we can continue to reduce it because inflation continues to reduce. There are some companies that will have to contract debt in domestic currency. They'll start taking credits in domestic currency. So it's one of the advantages that we see in this process, where a reduction in the rates, global rates, will allow us to have better rates, lower rates in our country. Thank you.
I think we have time for another question. Okay. I think if we work all the way through the panel, we'll just have a minute or two to summarize. I don't know if Eric, you had any. No, okay, we'll leave it up here on the stage. We were interested to ask you a little bit about how you see and how you treat cross-border events, global risks, shocks. And there's sort of two sides to this question that I wanted to ask, if it's okay. First, how are you assessing pandemics, climate, war, the impact and their effect on monetary policy in your country? A brief summation of how you interpret, how you absorb them. And maybe a part of that question is whether you are adjusting your tools, your models, your capacity, your approach to assessing international risks. We note that many shocks, which used to be considered stochastic, unpredictable, impossible to model, or are becoming sufficiently frequent that they are now part of planning in many financial fronts. And we were very interested to hear from you how you are looking out over the horizon and thinking about how you respond to and prepare for these international shocks from a monetary policy perspective. Let's reverse the order, if that's okay.
Okay.
Yes. We'll start with Uruguay, so far away, but so close to us all, please. Yes.
No, a ver, yo creo que
Well,
los bancos centrales estamos
I think that
acostumbrados
central banks are used to looking at these shocks,
nuestros modelos ahora estamos
and in our models now we are including the rate and learning to coexist with a rate that maybe if it doesn't last an international rate, maybe it won't last at these levels, but at the end of the process, it will be higher than what we've had in the last 15 years. But aside from this, I think that we're going to have to include and learn a bit from the new geopolitics that are coming into play in this fragmented world, and how this is going to make our decisions even more complex. We're at a moment in which we're all learning from that phenomenon and how it's going to affect us. So I think that maybe the financial conditions are managed, but there are some things that maybe go beyond this and that we will have to start to consider. However, once again, I think that sometimes we have to say that if we have a consolidated, healthy macro economy, this is always going to be better, and we're going to be better prepared for these shocks. But I think that would be the thing. Instead of worrying so much about how to interpret, for example, or try to determine how long the war in Ukraine is going to last.
Governor Biles.
Yes, apart from the forever present risk of energy cost, which is very important for us because we import 90% of our energy. I think not just the geopolitical instability, which has a knock-on effect on freight prices, it shakes confidence generally in prices and makes expectations be higher than they necessarily should be. And that's a frontier that we're keenly aware that we need to work on more to educate in order to get expectations to be more realistic. But when we have geopolitical events that are undeniable and can have tremendous ripple effects, it's very difficult to stop pricing by business people to, as an insurance policy against shortages, against currency fluctuation. So it's a frontier that I think that at least for the next couple of years, we're going to have to get better on how to manage expectations.
Thank you very much. And Governor Madrigal.
Sí, bueno, para nosotros,
Well, yes, to us, well, we always start by saying that we are a small and open country. And that's what in economic terms indicates that we take prices. We're not going to change the world isn't going to change us. There are things that we have to include in our process for the development of public policies. One is the demographic change. We're becoming older, we're aging, and the other is climate change. And another very, very interesting thing for us in the last 24 months could be this global polarization. All this talk about de-dollarization, it's part of a more generic, more macro process of polarization in the world, and we've seen it. We see it in our societies. We're during the times of alternative truths, and so this is in general terms. Now, as to the specific part, clearly we have to improve our macro frameworks. In practice, this is extremely complex. We're in this process of fiscal consolidation, so we have to build those spaces. And part of the argument of central bank in the past 2 years, after a relatively low level of reserves, is that we have to prepare for eventual shocks. And that's why the reconstruction process of reserves is so important. And we're not worried about energy shocks where importers of energy, especially for transportation. Of course, there are structural changes that are being made in Costa Rica. We want to change the energy that we use for transportation, depend more on electric buses rather than those that run on hydrocarbons or fuel, or what we could call heavy industry. We want to depend on other sources of energy, but what we have to do is include those risks, and part of the prudence that with which we've been lowering interest rates is that we evaluate the geopolitical risks on a monthly basis that appear and create the spaces from a point of view, a fiscal point of view, and of monetary policy. So if necessary, we could have an anti-cyclic economy. I'm going to start with something that Diego mentioned. The macro consolidation undoubtedly contributes and offers us better leverage to face shocks or turbulence that are sometimes normal in this global consolidation process, especially with geopolitical risks as the ones we are seeing now. And in that context, what risk are we seeing? At a short term, as I mentioned at the beginning, after a period of global disinflation, there are some costs that are presenting reversion, and that is behind our inflation forecasts that we have. Always in the context that inflation after 2 years, it will be in convergence with a target. This is transitory, but it's still present there. And at a global level, we see that the decrease in inflation it continues to show higher persistence or greater, or not as slow on the side of services. Consumption behavior, labor markets in some countries are still indicative that that process can continue to be slow or pose a certain level of difficulty. We're in a context with higher levels of uncertainty at a global level. This is undoubtable. And the deterioration of the geopolitical conditions that I mentioned at the beginning, this means that we might have greater impacts than what we're currently seeing. And we have conditions in which there is pressure on fiscal balances by many economies, even developed economies. There's a lot of fiscal demand that is arising in this context of war pressures, climate change pressures, pressures of different types, and some doubts on how the process, this convergence process, continues in the monetary policy. The effect, which has a lot to say in the global financial conditions, and the financial channel reaches all the economies. Concern also for the development of Chile. We have to look closely. We have important imports, copper, etc. And there we see some points, some strengths, but also some weaknesses. We have not solved some issues, but there is a force that is demanding some commodities from the industrial sector that have maintained some prices above what one would have expected without that factor present.
This energy transition does help with some commodities prices. That's another factor that we're aware of. The point is that in this context, on the uncertainty of the situation financially worldwide, what becomes very important is what happens with neutral rates, which is part of the discussion. From a monetary policy standpoint, that's a relevant factor. It's a discussion that's ongoing and that we need to continue. Thank you. Governor Villar, please. The international context is critical. From the standpoint of modeling, I would say that what we normally do is we have satellite models. In other words, we don't try to apply the same models that we use for inflation. We need models that give us input for the bank's basic models to predict inflation. We try to keep these two things separate, and I think that also reflects a strategy where in order to deal with so much uncertainty, so much volatility in international markets, you need to have a well-structured macro with significantly strong buffers with international reserves, and to have a flexible exchange rate that can absorb those international shocks. Now, on the impact of geopolitical tensions, what I would say is, unlike other countries, perhaps like Mexico or Costa Rica, Colombia is not benefiting from nearshoring with the United States. For some countries, that's been very important. For Colombia, that's not something we've experienced. I think it's quite common in South America. I don't know if that so-called benefit from tensions with China, the tensions that could affect international energy prices for Colombia. In the short term, that turns into a positive because we are oil exporters. So an increase in prices does benefit us. But again, it's a relative benefit. It's temporary, and we need to be very careful about it and not rely on it too much, because there's tremendous volatility from one day to the next. And so what's important is to have a significant buffer there. And have an exchange rate that can absorb shock.
Conversation. Thank you so much. I'm not sure I could summarize, but I'll offer this, if it's okay, because I think we're sort of obliged morally or ethically to summarize something. When you have we have central banks that are independently functioning, utilizing the flexibility of their exchange rates and of the tools at their disposal in order to bring stability, macroeconomic stability, to emphasize the value of these buffers, these cushions, colchones that you were mentioning, then the region looks very different in 2024, perhaps, than it did in 1994. Maybe this is the point that we were discussing before, and I think that you brought this forward, whether we talk about the financial sector and the impacts of shocks, or we talk about how you're responding to shock, or we talk about how you treat and view external shocks going forward. It is these same tools. And the point, I guess, that Governor Labat made, that with a well-run macro, is probably your best prevention method for dealing with all of the exogenous pressures that our economies are under. We care about these topics at the IDB, not just because we want our governors to be happy and to be respected, but also because it matters to the people of the region. It matters to the people in your country, because inflation is regressive, because investment requires stability. The greatest predictor of infrastructure investment, for example, is macro stability. And it looks very different in this region now than it did 30 years ago, largely built on the backs of our central banks. So I'd like to thank you for being here and for being our partners. And with that, thank the audience as well for joining us in this conversation. Thank you.